So what if I told you there's a single mathematical formula, one that was basically just scribbled on a blackboard back in the 70s, that completely rewired the engine of global finance? I mean, this one equation literally unlocked trillions of dollars in value, turned risk itself into something you could buy and sell, and helped make Wall Street the powerhouse it is today.
You know, when the formula was finally published, one trader famously said this: it was like the secret was finally out. The key to pricing the future was no longer just some gut feeling. It was right there in a formula for everyone to see. And yeah, it was a moment that promised to make some people incredibly rich. It definitely delivered on that promise.
All right, let's really get into it. This whole story boils down to a pretty simple question, but one with a ridiculously complex answer. How do you put a price on a choice? That's it. That's the fundamental problem the Black-Scholes-Merton model was designed to solve.
So, here's how we're going to break it all down. First, we'll look at the equation itself. Then, we'll dig into the problem it was trying to solve. We'll walk through its recipe, look at the perfect world it assumes, see where it kind of breaks down in reality, and finally, figure out why it has such an incredible, lasting legacy.
First things first, let's meet the guys who created this thing. You had Fisher Black, an applied mathematician, and Myron Scholes, an economist. They published the original paper back in 1973. Right after, another brilliant mind, Robert Merton, expanded on the math. That's why it's really called the Black-Scholes-Merton model. And this work, it was so revolutionary that Scholes and Merton won the Nobel Prize for it in 1997. Fisher Black had sadly passed away by then, but the Nobel Committee made sure to acknowledge his crucial role. And that Nobel was seriously well-deserved. I mean, why? Because this one formula gave traders the intellectual key they needed to unlock the entire modern derivatives market. Today, the notional value of that market, it's estimated to be over $1 quadrillion. That's a 1 with 15 zeros, 1,000 trillion. This model gave people the confidence to price and trade these incredibly complex things on a massive, massive scale.
But to really appreciate the solution, you've got to understand the problem they were wrestling with. And it all revolved around these financial instruments called options. So what is a fair price for a choice?
An option is pretty much exactly what it sounds like. It gives you the right to do something, but not the obligation. Think about an airline. They might use options to lock in a future price for jet fuel to manage their risk. But let's use a simpler stock example. Let's say you buy a call option for Apple stock. For a small fee, this gives you the right to buy one share of Apple for, say, $100, that's called the strike price, 1 year from now. Now, if in a year Apple is trading at $130, great. You exercise your option, buy the stock for $100, immediately sell it for $130, and you just made a nice profit. But if Apple's stock drops to $70, you just do nothing. You let the option expire, worthless. All you've lost is that little fee you paid up front.
And right there, that's the core dilemma. The value of that choice, that option, totally depends on Apple's future stock price. And that is completely unknowable. Before Black-Scholes came along, pricing this stuff was more of an art than a science. Traders just went with their gut, used some rough rules of thumb. There was no standard, logical way to put a price tag on all that uncertainty.
The Black-Scholes model just changed everything. It gave the world a formula, basically a recipe, for calculating the theoretical price of one of these options. And just like any good recipe, it's based on a few key ingredients that you just plug in.
Okay, so there are 5 key ingredients in this recipe, and they all make perfect sense. First, you need the current stock price. Makes sense. Then, the strike price. That's the price you have the option to buy at. The third is time. An option is more valuable if there's more time for things to happen. Fourth is the risk-free interest rate, which basically accounts for the time value of money. And finally, the most important, and by far the trickiest ingredient, volatility.
So what makes volatility the secret sauce? Well, think about it. The first 4 ingredients, they're just numbers you can look up. They're observable, they're concrete. But volatility, that's a measure of how much a stock's price is expected to swing around. That has to be estimated. An option on a big, stable, kind of boring stock is way less valuable than an option on some wild tech stock, right? Because bigger swings mean a bigger chance of a huge payoff. Volatility is the one subjective piece of the puzzle, and that's what makes this whole thing a dynamic game.
Okay, let's make this real with a quick example. Imagine we want to price a call option. The stock is currently at $165. We want the option to buy it at $170, and the option lasts for 3 months. We estimate the stock's volatility is about 20%, and the risk-free rate is 5%.
You take those 5 numbers, you plug them into the Black-Scholes formula, and bam, it spits out a theoretical price. This gave every trader on the floor a common logical starting point to negotiate from. But, and this is a huge but, here's the catch. For all that beautiful math to work out so cleanly, the model has to make some pretty big assumptions. It has to operate in a kind of perfect, idealized financial world. It's kind of like a physics problem that just assumes there's no air resistance. In this perfect little world, stock prices move randomly, but they always follow a nice, neat bell curve. So no shocking, out-of-the-blue market crashes. In this world, volatility never changes, interest rates are constant, stocks don't pay dividends, and there are absolutely no trading costs or taxes. It's a beautifully clean, but a completely sterile version of reality.
Of course, the real world isn't clean or perfect, not even close. It is messy. And when the model's perfect world smacks into the hard reality of the actual market, well, that's when we start to see some really interesting cracks appear. I mean, let's just put them side by side. The model assumes volatility is constant. In the real world, it's changing every second. The model assumes that nice, normal bell curve for returns. Reality gives us what we call fat tails, which is just a fancy way of saying that extreme events like the 1987 crash happen way more often than the model would ever predict. The model says no sudden jumps. Real markets are filled with them. And frictionless markets? Yeah, right. Ask anyone who's ever paid a brokerage fee.
One of the clearest examples of this disconnect is something called the volatility smile. The model says that for any given stock, the volatility should be the same no matter what strike price you're looking at. But in the real world, nope. If you actually look at the market prices of different options and work backwards to figure out what volatility the market is implying, you get this smile shape. Options that are way out of the money often trade at a higher implied volatility. It shows that traders are actively pricing in a much greater chance of those extreme moves, those fat tails, than the model assumes is possible. So what does all this mean in practice? Well, John C. Hull, who literally wrote the textbook on all this stuff, puts it perfectly. Traders aren't using Black-Scholes like a crystal ball to find the one true price of an option. It doesn't work that way. Instead, they use it as a tool. They look at what the market is paying for some options, figure out the implied volatility, and then use that to price other, less common options consistently. It's a framework for relative pricing, not some machine that predicts the absolute truth.
And that brings us to the really big question, right? If we know the model's assumptions are flawed, if we know it doesn't perfectly match reality, why, after half a century, is it still the undisputed king of the options world?
Well, there are a few huge reasons. For one, it's a universal benchmark. It's the starting point that everyone in the market agrees on. Second, it created a language. When you hear traders talking about implied vol, they're using a concept that comes directly from working the Black-Scholes formula backwards. It's literally how they quote prices to each other. Third, it's the foundation for managing risk. The model gives you these metrics called the Greeks, like delta, that tell a trader exactly how to hedge their position. That's the backbone of the entire industry. And finally, let's be honest, it's fast and it's simple. The math is elegant, which means it's super quick to calculate, and that is absolutely critical in fast-moving markets. So at the end of the day, the big takeaway is this. The Black-Scholes-Merton model isn't powerful because it's right. It's powerful because it's useful. It gives everyone a shared framework, a common language, and a logical way to think about price and manage the crazy uncertainty of the future. You could think of it like a map. A map is never the territory itself, right? But a good map is still incredibly helpful for finding your way. And that kind of leaves us with one last big thought. We've built this colossal, multi-quadrillion-dollar global market on the back of mathematical models that we know are imperfect, that we know are simplifications of reality. On one hand, it's an incredible testament to human ingenuity, but on the other, it really makes you wonder about the limits of our ability to ever truly master and price the fundamental, messy unpredictability of the future. What do you think?